Imagine waking up one day, not to an alarm clock, but to the freedom of choosing how you spend your time. No 9-to-5 grind, no endless meetings, just the life you've always dreamed of. Sounds ideal, right? Well, it's not just a fantasy. It's achievable, and the secret lies in one powerful financial principle: compounding. In this video, we're going to break down the smartest compounding money hacks to retire early that can fast-track your journey to early retirement. No complicated jargon, just simple strategies that can make your money grow while you sleep. But before we dive in, here's a quick truth bomb. It's not about how much you make. It's about how you make your money work for you. So if you're serious about escaping the rat race and reaching financial freedom faster than most, stick around. These hacks could change your life. Let's kick things off with the first compounding money hack to retire early, starting as soon as possible. The best time to start was yesterday. The second best time? Today. When it comes to compounding, time is your best friend. Even small amounts invested early can snowball into massive wealth over time. Why? Because compounding isn't linear, it's exponential. Let's say you invest $5,000 at an average return of 8% annually. In 20 years, that turns into over $23,000. But if you wait 10 years to start, you'd end up with only $10,000. The difference? Time. Many people think they need huge amounts to start investing. The reality? Consistency beats size. Regular, small investments often outperform sporadic, large ones. It's not just about when you start. It's about how often you contribute. Even small, consistent deposits build momentum. Start where you are, even if it's just $50 a month. The key is to let time do its magic. And here's a bonus tip. Set it and forget it. Automating your investments eliminates the temptation to skip months, allowing compounding to do its work uninterrupted. To truly harness the power of starting early, think about the long-term ripple effect. Early investments don't just grow, they create financial flexibility. This means having more choices. Whether it's buying your dream home, starting your own business, or retiring a decade sooner than planned. Starting early also allows you to weather market volatility more comfortably. With time on your side, short-term dips become minor blips in your overall growth curve. It's like running a marathon. You pace yourself and keep moving forward, regardless of the occasional bumps along the road. Remember, the key to wealth is not just earning more, it's starting sooner. Time in the market always beats timing the market. All right, let's move on to the next compounding money hacks, making your savings work harder. Most people think high-interest accounts are only good for emergency funds, but there's a hidden advantage. Some high-yield accounts now offer interest rates that actually keep up with inflation, a rarity in traditional banking. But here's the trick. Use these accounts not just for emergencies, but also as short-term compounding vehicles. It's low risk and your money still grows. Think of it as your financial waiting room, where funds grow while you plan bigger moves like investing in stocks or real estate. According to a recent bank rate study, high-yield savings accounts averaged 4.5% APY in 2023. Over 10x the national average. Let me tell you about Jake. A few years ago, Jake was living paycheck to paycheck, barely scraping by. He'd always thought investing was for rich people, and that his modest salary wouldn't make a dent in any real savings goal. But one day, after reading an article about the power of compounding interest, he decided to take a chance. He opened a high-yield savings account with just $500. At first, the interest felt insignificant, a few extra dollars here and there, but Jake kept adding $50 a month, watching his balance slowly but steadily grow. Fast forward 2 years, his emergency fund had doubled. And here's the kicker. He didn't change his lifestyle or make massive sacrifices. It was simply the magic of compounding interest doing its thing. The emotional payoff? Jake no longer panics when unexpected expenses pop up. His savings act as a cushion, giving him peace of mind and the freedom to take bigger financial leaps, like finally investing in the stock market. High-yield accounts might not make you rich overnight, but they are a solid, low-risk foundation. They offer a psychological boost, too. Seeing that balance grow, even slowly, builds confidence and momentum. Have you ever used a high-yield savings account? If not, maybe it is time you consider one. Let's switch gears and talk about growing your investments through automatic dividend reinvestment plans, DRIPs. Why spend your dividends when they can work for you? DRIPs allow you to automatically reinvest dividends to buy more shares, essentially turning passive income into an active growth strategy. It's like planting a tree and using its fruit to grow more trees. Over time, this reinvestment creates a compounding snowball effect, accelerating your path to early retirement. Think of DRIPs as a garden. Every dividend is a seed. The more you plant, the bigger your harvest. And the best part? Many DRIPs come with reduced or zero commission fees, meaning more money stays invested. To maximize DRIPs, target dividend-paying stocks with a history of steady payouts. Focus on companies with solid fundamentals and consistent growth. This way, your reinvested dividends buy shares in stable, reliable businesses. Let me introduce you to Emily. She's a 32-year-old teacher who decided to take her finances seriously. With limited extra income, she started small, just $100 a month, into a dividend-paying stock through a DRIP. At first, the growth seemed slow. But Emily stuck with it. Over 5 years, her $100 monthly investments snowballed. Her dividends didn't just sit there. They bought more shares, which generated even more dividends. Fast forward, and Emily had doubled her initial investment, all by letting the DRIP work its magic. What's the key here? Emily didn't have to constantly monitor the stock market. She didn't need insider tips or market timing. Her DRIP automated the process, steadily growing her portfolio while she focused on her teaching career. Emily's story highlights how anyone, even those with limited income, can use DRIPs to build wealth passively. The magic lies in consistency and patience. Have you tried DRIPs? Drop your experiences or questions in the comments below. Let's turn this space into a hub of shared wisdom. Moving forward, let's talk about the secret sauce to accelerating compounding, monthly contributions. Consistency is the real MVP here. Monthly contributions, even small ones, compound faster than random lump sum investments. Why? Because you're constantly feeding the compounding machine, allowing interest to build upon itself at a faster rate. Remember, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Albert Einstein. Set up auto investments to make this seamless. Treat your savings like a bill, non-negotiable and recurring. The real power lies in removing emotion from the equation. Markets will fluctuate, but consistent contributions ride out the highs and lows, ensuring long-term growth. Let's take Oprah Winfrey as an example. Long before she became a media mogul, Oprah was diligent about consistent investing. In her early career, she committed to setting aside a portion of every paycheck, not massive amounts, but steady, intentional contributions. She didn't chase risky investments. Instead, she focused on slow, stable growth. Over time, those regular contributions compounded, building a financial foundation that allowed her to invest in her own production company, ultimately leading to her billion-dollar empire. What's the takeaway? You don't need millions to start. You need consistency. Monthly contributions are like watering a plant. Skip a few weeks, and it wilts. Water it regularly and it thrives. Plus, think about the psychological edge. Watching your balance grow month after month builds momentum. It's motivating and makes you less likely to break the habit. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Let's dive into a hidden strategy that could supercharge your compounding and help you retire early: tax-advantaged accounts. Taxes are one of the biggest threats to compounding. The more you pay in taxes, the less money you have working for you. That's where tax-advantaged accounts like 401ks, IRAs, and Roth IRAs come in. These accounts allow your investments to grow either tax-deferred or tax-free, supercharging the compounding effect. But here's the part most people overlook. The wealthy don't just use tax-advantaged accounts, they master them. Ever wonder how some billionaires manage to pay less in taxes than the average middle-class family? It's not luck, it's strategy. They pour money into vehicles like Roth IRAs, use backdoor conversions, and leverage tax shelters within legal limits. While the average person debates between saving or spending, the wealthy are busy finding ways to shelter their earnings and let them grow untouched. The tax code wasn't exactly written to benefit the everyday worker. It was written by people who know how to use it to their advantage. Shocking, right? One of the smartest strategies is utilizing health savings accounts, HSAs. It's one of the few triple tax-advantaged accounts. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are also tax-free. But here's the kicker. Many use it as a stealth retirement account by paying current medical expenses out of pocket and letting the HSA grow untouched. Want another? Real estate investors often use depreciation to reduce taxable income, even when their properties are generating positive cash flow. It's like legally hiding money in plain sight. The big takeaway? If the wealthy are using these tools to minimize taxes and grow wealth faster, why wouldn't you? Now, let's talk about something that makes many investors sweat: market volatility, and how you can turn it into your secret weapon. Most investors panic when markets dip, but the savvy ones, they see opportunities. When prices drop, your regular contributions buy more shares. This is called dollar cost averaging, and over time, it can lead to bigger gains. Studies show that investors who continue contributing during downturns outperform those who pause their investments. So instead of running from volatility, lean into it. Every market dip is a chance to boost long-term returns. Take Sarah, for example, a software engineer who started investing during a market high. When the market dipped 15%, she panicked and considered pulling her money out. But after consulting a mentor, she stuck with her plan and even increased her monthly contributions. Fast forward 2 years, and Sarah's portfolio not only recovered, but outperformed many of her peers who had pulled out during the downturn. The key? She viewed volatility as a sale, not a setback. Here's the thing: volatility is natural. Markets rise and fall, but historically, they trend upwards over time. Every dip presents a buying opportunity that could pay off handsomely in the long run. While the average investor fears a bear market, seasoned investors see it as the best time to buy. It's the classic buy low, sell high strategy, but only if you can stomach the short-term chaos. To truly harness market volatility, consistency is key. Keep your contributions flowing, even when the market seems turbulent. It's tempting to pull out during downturns, but staying the course ensures you're buying shares at lower prices, setting yourself up for greater gains when the market rebounds. Equally important is mastering your emotions. Market swings can trigger panic, but reacting impulsively often leads to costly mistakes. Instead, take a step back, breathe, and stick to your long-term plan. Investing isn't about winning every battle, It's about thriving over the entire journey. And let's not forget the power of diversification. By spreading your investments across various sectors and asset classes, you reduce risk and create a buffer against severe market swings. Think of it like a well-balanced diet for your portfolio. No single event can throw everything off course. Remember, the stock market is a device for transferring money from the impatient to the patient. Embrace volatility, and you'll turn what most see as a threat into your greatest financial ally. Finally, let's unlock the final compounding hack, building passive income streams. Here's the secret sauce. The more income streams you have, the more fuel you're throwing into your compounding engine. Think rental properties, royalties, affiliate income, or even digital products. These streams not only diversify your income, but also give you extra cash to reinvest. The beauty? Many passive income sources can grow exponentially themselves, adding layers to your wealth-building strategy. A study by Tom Corley found that 65% of self-made millionaires had at least 3 income streams. Let's take Jay-Z as an example. Known initially for his music, Jay-Z didn't stop there. He expanded into clothing lines, real estate, tech investments, and even his own streaming service. His approach to creating multiple passive income streams turned him from a successful artist into a billionaire entrepreneur. While his music made him famous, it was his smart investments and diverse income strategies that built long-lasting wealth. Jay-Z's strategy shows that passive income isn't just about sitting back and letting money roll in. It's about building a foundation that continues to pay dividends long after the initial effort. Whether it's royalties from music, rental income, or digital products, the goal is to create assets that keep generating income while you sleep. Start small, but stay consistent. The goal is to create income that works while you don't. What's your dream passive income stream? And there you have it. 7 compounding money hacks to retire early. Let's take a moment to reflect on the journey we've just covered. Compounding isn't just a financial strategy, it's a mindset. It's about making smart, intentional moves today that will pay off massively tomorrow. We explored the importance of starting early. The sooner you begin, the more time your money has to grow, creating a financial snowball effect that gains momentum with every passing year. Then we dove into the power of high-yield accounts. These aren't just for rainy day funds. They're the unsung heroes that make your idle cash work harder. We uncovered the brilliance of drips, where your dividends don't sit idly. They go back to work, buying more shares and compounding your growth. Monthly contributions? That's where consistency becomes your best ally. Regular automated deposits ensure your investment journey never hits pause, even when life gets busy. Tax-advantaged accounts were another game changer. The wealthy use them not just to save, but to supercharge their compounding while legally minimizing taxes. And when volatility hits, we learned it's not a signal to run, it's a signal to buy. The market's ups and downs aren't obstacles, they're opportunities. Finally, we unlocked the ultimate wealth builder, passive income streams. These are the engines that keep running even when you're not. From rental properties to royalties, the goal is to create income sources that fuel your compounding without constant effort. Here's the big takeaway. Building wealth isn't about giant leaps. It's about small, consistent steps that add up over time. Compounding is patient, relentless, and when used wisely, unstoppable. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found this video valuable, I highly recommend watching my next video, which is the perfect complement to this one. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching, and I'll see you in my next video. Until next time, keep compounding, keep growing, and remember, financial freedom isn't a dream, it's a strategy.